Hi everyone, I created this spreadsheet to help you understand whether you should buy a property inside of a limited company or in your own personal name. Now, the reason why I created this spreadsheet is because we have so many people asking that question. Should I buy my next buy-to-let property in a limited company? And I thought that this should be able to be answered relatively easily. And that is why we've designed this spreadsheet, which you can download for $9.95 and work out whether you should be buying properties in your own personal name or indeed a limited company. Let's get straight to it. You would have seen that there are assumptions, purpose, disclaimers. Please do read that. This is for education purpose only. I would always say get a tax consult booked with your accountant, your tax advisor, but not your friend down the pub. Okay, so with that in mind, what we want to do is look at the property. So anything that's shaded in blue, you can enter the details. Anything in white will be forced. So in regards to this spreadsheet, what we want to do is look at the property value. So clearly this will be the purchase price of whatever you're buying. So let's put in £250,000. And then mortgage, typically people will go for a 75% mortgage. You'll notice that this spreadsheet already does that for you. You can enter a different number should you wish to. I'm going to leave it just there for now. Now, mortgage interest rates, you do need to speak to a mortgage broker before you enter the data into this sheet. You want to understand whether the mortgage interest rates will be the same if you have it in a limited company, which I very much doubt. And if it is going to be higher inside a limited company, how much more? We've assumed here that it's 1.25%, but you'll notice it's in blue, so we will be able to just change that. I'm going to just change that to 3% so you can see the change happening over here as well. We've assumed 1.25%, but it could be more, it could be less. What you'll notice that money invested, we've assumed that it's a 25%. Based on the difference between the property value and the mortgage you're getting. But again, you can change the mortgage value and that will give you then the money invested. What you'll do then is enter the rental income. And you'll notice that on the right hand side in a company, it's already fixed for you. And that's because we want these same, we want to compare apples with apples, not apples with pears. We will then put the rental income across there. This will calculate the mortgage interest cost for you. You'll notice that the limited company is already done. And that is based on the higher mortgage interest rate, as you see above. And then you may have other costs. If you're using a letting agent or you've got other leasehold costs, then those may be entered into that. Now, this particular property, you can see here, makes a real profit of 81. This actually makes a loss of 114. So is that right? 114? Yes, it will be. And the reason for that, minus 114, I don't have to double check that, is simply because of the greater mortgage interest cost. So I've always said, and I always will maintain, that buying a property inside a limited company will be more expensive if you are using mortgages. Now, interesting enough, we do need to work out from a income tax perspective, section 24. And what you will see there is that we've got profit brought forward from 81 above. And we need to add back the mortgage interest cost because that will not be allowed going forwards. And therefore, we have a profit restated, which is for tax purposes only. This is not real profit, please bear in mind. Now, from that side of things, you'll notice that the tax side of things will be 220. That is based on the 40% tax ban. You do have a tax reducer of 20% of whatever the mortgage interest cost. That's again auto populated, which will give you the net tax of £126. You'll notice that this one over the right hand side says minus 22. The reason for that is because you can get tax relief on it. So if you can go back to previous tax years, you can get a tax reducer from your previous tax returns. You'll notice cash after property shows you with £45. Again, now this is a negative, so this is not a good property to show you, but I want to show the workings and then we'll go through another example just to make sure it's, when you use it, hopefully you'll be making more profit. And then cash from a limited company perspective, minus 92. From the face of it straight away, even though you're using a limited company, it is tax efficient. You'll end up paying more tax simply, you'll have less of a cash injection from this property portfolio. Now, if you take the money out, you can't obviously take out minus 92. But if that was a positive number, which we'll go through another quick example in a second, then you will have a tax position of £30 depending on your tax band. Now, if you're a high rate taxpayer, it will be 32.5. If you're a basic rate taxpayer, it's 7.5. And if you're an additional rate taxpayer, it's 38.1. And you can change all of those in the sheet. So let's go ahead then. Let's just make sure that we have a better property to look at. So let's imagine that we get £1,000 worth of rental income. Same thing now. We'll go quicker through this example. So £1,000 worth of rental income, same in the limited company. Mortgage interest cost of 469,664 in limited company. Clearly, as before, it is more. £100 worth of other costs, and that leaves us with 431 versus 236. So 431 in your own personal name versus 236 in a limited company. Now, the tax brought forward will be 431. Add back the mortgage interest of 469, gives us a taxable profit of 900, not a real profit, just to restate that. And what will happen is that you'll have a 40% tax liability, if you're a high rate taxpayer, this is, against that £900. And what we'll look at this here is you'll have a £45 tax bill in a limited company. You do have a 20% tax reducer for your self-assessment, so you'll have 266 there as a high rate taxpayer. And cash from property tax, cash from property after tax is 165 versus 191. So here it's saying, well, that's fine. We want to take this money out of the limited company. What effect will that have? And you'll notice that we are saying here that we've got £165 cash from your own personal name versus 118 if you take the tax position. So we're looking at how much money will be left after tax of income tax. And if you're an additional rate taxpayer, you'll be 38.1%. If you're a high rate taxpayer, that will be 32.5%. So hopefully that will give you an indication of exactly how this works. And indeed, it should show you which tax structure to buy your next buy-to-let property. Hopefully that's been useful, and indeed that this helps you make the right decision for you.